The 2012 presidential election series, Middle Class Taxpayers Must Pay More, Awakening the Middle Class Giant, a video book presentation. A video book is a narrated electronic book that can be streamed or played on your computer or in a DVD player. As a book, a video book is not intended to entertain, but to educate and inform. This video book is by and for middle class taxpayers, a production of the Public Square Today, hearing all sides, following one truth. FBI warning, the information contained is copyrighted and offenders will be prosecuted. A swing state, middle class taxpayer, CFO, CPA's perspective. I'm a CPA and I've looked at the numbers. The math is simple and the ideas are easy to follow. I will prove to you in 3 20-minute presentations that your tax rates must increase 2 to 4 times. The numbers could not be any plainer or more clear. If you earn between $75,000 and $250,000 a year, you will be particularly hard hit because our nation's economic problems have reached a magnitude that prevents resolution from any other tax-paying group. I will prove to you that as a middle-class taxpayer, your economic future, not anyone else's, is on the line. Cast your vote on November 6th in the best interest of yourself and your loved ones. You need to be certain you know whether the following 3 points are true, almost as if your life depended upon it, because your take-home pay sure does. First, the way to resolve the debt and deficit is to close big oil, Wall Street, and big business loopholes and deductions, or corporate jet loopholes and deductions, or to make America's wealthiest citizens pay their fair share through mechanisms similar to the Warren Buffett rule. Second, the current economic recession, debt, and deficit escalation are the result of failed policies of the past, primarily Bush's presidency, which favored Wall Street, big oil, big business, and cost Americans trillions of dollars in lost wealth. Third, energy price escalation is resolved through American energy independence, but the future is clean, green energies, now, solar and wind, etc., not really oil or fossil fuels. I'm an ex-CFO, and what I love about the financials of a household, firm, or nation is they are blind to all things but the dollars and the cents. They provide us an economic scorecard of the decision-making capabilities of those in authority. And in the United States, as a middle-class taxpayer, we're in authority. So let's see how we've done managing the affairs of our nation. Part 1 is we're going to discuss the first of those 3 previous points. The way to resolve the debt and deficit is to close big oil, Wall Street, big business loopholes and deductions, corporate jet loopholes and deductions, and make America's wealthiest citizens pay their fair share through mechanisms similar to the Warren Buffett rule. During the first and second presidential debates, 3 ways were mentioned by President Obama to close the deficit and rein in the ballooning debt. As encouraged during the debate, let's do some basic arithmetic to determine whether these are viable or real solutions, because to the extent they are or are not, they affect what we, as middle-class taxpayers, will pay. The first, big oil loopholes and deductions. From the first debate, big oil loophole deductions were explained to be a $4 billion potential deduction offered to the industry by the federal government, which typically runs $2.8 billion annually. To resolve the 2012 projected $1.4 trillion deficit at the time of this production alone is equivalent to 500 years' worth of that $2.8 billion deduction. Second, corporate jet loopholes and deductions. The U.S. corporate jet fleet is estimated to be right at about 11,000 planes. To resolve 2012's projected $1.4 trillion deficit alone, you'd need 14,000 of these jets sold annually, each and every year, about 30% more than the sum of all U.S. corporate jets owned. So it's mathematically impossible for this deduction or loophole to be viable either. One of the most difficult problems when trying to discuss dollars and cents with regard to our federal government is that there are so many of them that people lose interest because they can't relate to the dollar amount. So before we consider the wealthiest Americans or the 1%ers paying their fair share and what that means to each of us as middle-class taxpayers, we need to appreciate the magnitude of the numbers involved. So let's consider the big oil deduction as an example relative to our nation's deficit in the context of a typical household budget. Trying to balance the federal budget with a big oil deduction or loophole amount, which is only worth billions of dollars, is like trying to pay off a $14,000 debt in the center of the screen that's due in 12 months with only $28. Or in the far right of the screen, it's like being short every month on your household budget by $1,400 and hoping that your child's piggy bank of $2.80 might satisfy your banker or your landlord. These are meaningless gestures, mathematical impossibilities. They may sound good, but they mean nothing. The percentages at the bottom confirm the ratios are equivalent. Moving on to America's wealthiest 1%ers paying their fair share, we went to the Obama-Biden re-election website regarding the Warren Buffett rule because this was mentioned in the second debate as part of a balanced strategy of taxation and discretionary spending cuts to resolve the nation's deficit and debt problems. You can pause the video to read the excerpt from the website we've provided if you wish, but it's not necessary. The Warren Buffett rule calls for higher taxes similar to middle-class tax rates on those making over $1 million. To evaluate the Warren Buffett rule, we went to the IRS website and pulled down the latest IRS stats for individual income tax filers from 2009. There's been little economic growth, so the numbers haven't changed much over the past 2 years. Total AGI of individual taxpayers in the U.S. is just under $8 trillion, with tax collected at $866 billion for an average tax rate on individuals in the U.S. of 11%. People earning less than $50,000 pay 3.5%. We've rounded it to 4 in this table. And those making over $1 million pay 25%, while those earning between $50,000 and $1 million pay 12%. How can the WBR, or the Warren Buffett rule, bring tax rates on those earning over $1 million to equivalency with middle-class taxpayer rates when the average tax rate on people earning over $1 million is already twice that of middle-class taxpayers? This doesn't make sense, but fortunately it doesn't have to for our purposes. Let's consolidate the 3 means of closing the deficit gap and reining in the ballooning debt as offered by the President to see the effect on the deficit. If you take current taxes from those subject to the Warren Buffett rule, you'd have $178 billion. If you ignore the inconsistencies of the WBR Warren Buffett rule on the Obama-Biden website and that of the IRS's, and increase the average tax rate on these individuals to say 50%, you'd bring in another $185 billion for a total of $363 billion. Earlier, we calculated the corporate jet deduction at $28 billion and big oil loophole at $4 billion. Actually, it runs 2.8, but let's just assume it's 4. We'd have a total with those 3 strategies mentioned in both debates for closing the deficit gap and reining in the ballooning debt at $395 billion. That versus our deficit of $1.4 trillion leaves us with a shortfall of $1 trillion. So almost 3/4 of the deficit is still unresolved using these 3 primary strategies. The debt, of course, remains untouched. Well, what if we stuck with the media's narrative of the 99%ers versus the 1%ers, and we taxed the wealthiest 1%ers at, say, 100%? What would we get? In this chart, the far right red bar is the U.S. deficit at $1.4 trillion. The yellow bar is corporate income in the U.S. at $0.9 trillion. The blue bar is America's wealthiest 1%ers and their annual income at $1.1 trillion. The red line indicates that portion of the income that's generated by taxpayers that would qualify under the Warren Buffett rule, those earning in excess of $1 million a year, and they represent about 70% of the earnings of this group of America's wealthiest taxpayers. And of course, to the far left, we have Main Street, or the 5 trillers, or the middle-class taxpayer. They represent $5 trillion in income annually. The intersection of the yellow shaded region, of course, tells the story. America's richest, wealthiest 1%ers earn only $1.1 trillion. Our federal deficit is $1.4, so taxing this group at 100% still renders us short $0.3 trillion, as indicated by the yellow shaded region. Of course, again, notice the green bar to the left. That's the income of the middle-class taxpayer, 5 times more than the wealthiest 1%ers, or Wall Street's biggest corporations. Corporate taxpayers, again, represent only $0.9 trillion in total annual income. So let's examine a possible combination of rates on the wealthiest 1%ers and America's middle-class taxpayers to balance the federal budget and begin paying down the debt, because as we can see thus far, 1%ers alone won't resolve the issue. We're going to have to go to the middle-class taxpayer. Let's first lay out this table. In the columns moving from left to right, we find the following headings. First, the taxpaying group. Second, their annual earnings, or AGI. Third, the adjusted current tax column. And fourth, the current tax. 3 highlighted rows contain each of the 3 individual taxpaying groups in America as we've defined them. At the top are the 66 percenters, in red representing 66% of individual income tax filings in the U.S., hence the name. This group earns less than $50,000 a year, is 93 million strong. They earn $1.7 trillion in income annually, and in the far right column, they pay an average income tax of 3.5%, worth $61 billion to the federal government in annual income tax receipts. The second row, that's highlighted in blue, contains the 1%ers, who earn over $500,000 per our definition, are 700,000 strong, generate $1.1 trillion in annual income, and pay on average, in the far right column, 24% of their annual income, or $260 billion in tax receipts. The last highlighted row is in green, and these are the middle-class taxpayers, or as we'll sometimes refer to them, the 5 trillers, because they represent $5 trillion in annual income. Taxpayers in this group earn between $50,000 and $500,000 a year, are 47 million strong, and generate, as we indicated, $5 trillion in annual income. They pay an average of 11% of their income in taxes, or $550 billion. Notice the yellow ovals around the 1%er and middle-class taxpayer rates. To achieve a 30-year straight-line pay-down of the U.S. debt, which currently stands at $16 trillion, and eliminate the deficit, our calculations require a more than tripling of 1%ers' average tax rates, increasing them from 24% at present to 75%, and an almost quadrupling of the current average middle-class taxpayer tax rate of 11%, increasing it to just under 44% at 42%, to achieve a projected shortfall of $2 trillion, and we'd have $1 million to spare. And our $2 trillion is the current $1.4 trillion deficit, with $500 billion in principal pay down of the $16 trillion debt on a 30-year straight-line amortization schedule. And we've increased an unrealistic interest rate with a CBO of 0.5%, or half a percentage point, to 2.5%. We think that's more realistic, especially with all the quantitative easing and money printing. So that's what would have to happen to tax rates. Now, the problem with aiming taxation strategies at the wealthiest 1%ers is going to be the same problem that you'd have aiming taxation strategies at America's big oil companies or America's biggest corporations. That problem is one of flight risk. Regarding the 1%ers, in this slide we found 3 headlines on the web on the topic of renunciation of U.S. citizenship by America's wealthiest 1%ers. The problem with aiming, again, federal taxation strategies at this group is that they have the economic wherewithal to flee the country, which ultimately makes their income dollars out of reach, or at least as out of reach as this group wants them to be. According to these articles, 7 times more, or 700% more, 1%ers are renouncing their U.S. citizenship than in 2008. Thus, it's not likely this group would sit idly by while our federal government taxed their wealth away, meaning our previous scenario of taxation at 100% becomes highly improbable, if not impossible, to achieve. Furthermore, if these 1%ers leave the U.S. and take their tax dollars with them, it just puts that much more pressure on middle-class taxpayers to make up for lost tax dollars. Being the largest income group, they're already the aim, ultimately, of all federal taxation strategies. So if you reduce the 1%ers, then the middle-class taxpayers must make up this shortfall. We calculate that that's a difference, that shortfall is a 22-to-1 difference. So middle-class taxpayers on average have to double their tax rates, 22 middle-class taxpayers for every one 1%er who renounces his or her citizenship, to make up for those lost dollars. Because taxing the wealthiest 1%ers proved insufficient, and because corporate jets and big oil deductions and loopholes entered the discussion in both debates, we might, as middle-class taxpayers, be tempted to think that corporations should pay more before middle-class taxpayers should be looked to for tax increases. So let's look at that next. There are less than 3,000 corporations in the U.S. that pay almost 70% of all corporate income taxes. That's the red portion of the pie graph on the left. 54% of all corporate paid employee benefits. That's the red portion of the pie graph on the right top. And 57% of all corporate paid employee wages. That's the red portion of the pie graph on the bottom right. Think about these numbers. Over half of all employee wages and benefits that is of all American workers who work for corporations, are paid by only 2,800 firms. And this group, the same group, pays 70% of all corporate income taxes paid to the federal government. These are stunning figures given the number of the firms is so small. It would take less than 9 commercial jets to seat the CEOs of America's biggest corporations. How many American workers are employed by these firms? Well, we know that just over half of all working Americans are employed by small businesses, and the American workforce is about 140 to 150 million strong. So maybe there are 70 to 75 million American workers working for corporations, and maybe there are 40 to 50 million American workers who are employed by these big firms. But then again, maybe it's only 20 million. But then it could be 60 million. Well, whatever the number is, any risk in the loss of more jobs isn't worth it, especially right now. Remember, these 2,800 firms are managed by highly intelligent people with highly sophisticated means of determining where the most favorable business environments for their particular firm exists in the world. In the same way that America's wealthiest 1%ers will do everything within their power to avoid personal loss of wealth, just as you and I would, so too the CEOs and professional business managers of America's biggest and brightest corporations will do all within their power to avoid loss to the enterprises they run. So if any of these firms believed they could increase shareholder value by relocating anywhere outside the U.S., how long do you think it would take them to do so? Haven't we witnessed the exodus of American manufacturing to China, taking their investment dollars and jobs with them when the business environment in the U.S. became cost prohibitive, either because of overregulation, overtaxation, or just plain outright hostility, like the Occupy Wall Street movement? Just as was true for the 1%ers, it seems to be a highly risky economic and financial play to target these firms for increased taxation. Plus, the magnitude of our nation's current economic difficulties have simply become too large for either the biggest corporations or the wealthiest individuals to resolve them without the help of the middle-class taxpayer. The concern with a taxation strategy and mechanisms like the Warren Buffett rule is that they seem to be diversions for the true aim of any taxation strategy that the federal government employs, and that taxation strategy is one that taxes the middle-class taxpayer. This is true for no other reason than it must be true. To raise the trillions of dollars our federal government needs, as we showed in our sensitivity analysis, there is no place else to go but to the middle-class taxpayer. Our government's fiscal problems are simply too large at this point. The concern with increasing taxes on incomes between $100,000 and $500,000, however, is the potential harm to job creation, because over half of new jobs are created by individual taxpayers owning small businesses and earning between $100,000 and $500,000 annually. Indeed, over 90% of wage earners between $100,000 and $1 million are in this income group of $100,000 to $500,000. So that's smack dab in the middle of the middle-class taxpaying group. Conclusion. As middle-class taxpayers, we believe a better strategy than the Warren Buffett rule is one where the middle-class taxpayer embraces 1%ers, doesn't seek to have them taxed more. America should have a policy that welcomes the world's wealthiest individuals and corporations, because the more of these tax-paying entities there are, the lower the tax burden for the rest of us. In addition, these groups also provide business capital for investment and innovation and just raw job creation as well. So we must exercise great caution as middle-class taxpayers as we prepare for the upcoming November election. We have more writing on this election and the next 4 to come than we can possibly imagine. We must be particularly careful from whom we get our information as well. While it's somewhat vogue currently to be on the side of the middle-class taxpayer, how is it possible for television, news, media, and entertainer 1%ers to claim business and Wall Street 1%ers are out of touch with the middle-class taxpayer, while the media and entertainer 1%ers are not? Both of these groups are part of the same income tax brackets, i.e. media and entertainer 1%ers and business and Wall Street 1%ers. So doesn't that make them both equally out of touch? This ends part 1. Be sure to join us for parts 2 and 3. 2 failed policies of the past, and 3 energy independence. If you're still confused about November 6th, then consider watching or listening to other video books we have in this series. As we close, consider a couple of questions in case you don't watch the other two parts. When you apply for a job, do you want to work for a company with management or owners who run up a lot of debt and have no cash in the bank to make payroll? Or do you want to work for a company where the owners and executive staff are incredibly successful with little debt and lots of cash in the bank? Where do you think you'd stand a greater chance for pay raises, promotions, and other career growth opportunities? Our federal government has been run by attorneys for the past 70 years, who have collectively made enough bad fiscal decisions to create our present economic and financial conundrum. We wish we had more time to communicate the succession of bad policy decisions, all of which were completely avoidable. Watch our other video book presentations to get more information if you're so inclined. The point is, as American taxpayers, who need economic income to live and survive, we've been hiring lawyers with little, if any, economic or financial training to run the national economy. Isn't this a misalignment of skill, an objective, or need? Maybe we should try something different and put a successful business person with a lot of money, who's made a lot of money, and might be able to find ways to help us make a lot of money. Someone who understands finances and economics in the White House. Maybe that would stop the wealth stripping of the middle-class taxpayer. If you have a better idea, please let us know about it. We'll have our blog up next week. Go to www.awakenthemiddleclassgiant.com. Thank you.